So, hello and welcome to the third part of my conversation with the co founder of RoboQuant, Mr. Tim Hunter. Today, we are going to give you a reality check on backtesting and exactly how it works. And I hope you guys are enjoying this series. If you are, comment down below and let us know. So, just drop a like, subscribe, and let's get started. So, how can traders avoid overfitting a strategy just to make the backtest look good? Like I'm pretty sure you met a few traders who try to change too many rules about their strategy just to make the backtest look good and just to have that equity curve of exponential growth.
Yeah, that's also a very, very important point in algo trading. Obviously, there's a market for bots, and everyone who sells their bots, they want to make it as good as possible, so they tend to overfit their bots, and in reality, they will not perform like this. So you can. A very good metric is the Sharpe ratio. So if you have a Sharpe ratio in a backtest that is above 3 or 4, you just know this is overfitted. What you can do to prevent overfitting is simply using out-of-sample data in backtesting. We have made a tool for this, also this Chrome extension, the optimizer. Basically, it allows you to test all possible settings, find the most profitable ones, but then to prevent overfitting, you can run a backtest with out-of-sample data to validate if these results will also perform in a different date range. So that's very important. It's also very disappointing for many strategies because you will see it actually doesn't work as well. But that's the only way to find something that is really solid and robust.
Right. Okay.
And I have
Yeah.
to mention here, this is something that I see this all the time. There's many people like these ICT, the new generation ICT
Yeah.
guys like PB trading, Dodgy, blah, blah, blah. Of course, they make money. They have their strategies have nice winning streaks, but this is just overfitting. If you test the strategies over a longer period of time, they absolutely suck. They just happen to trade when they have a winning streak and maybe stop, or maybe they don't show when they have a losing streak, but that's very important. So that's also like overfitting.
All right. So, what should someone do if their strategy looks good in backtesting? Like, should they forward test it further, or should they just start with real money or even prop firms?
So this depends on the person. Me personally, I'm not such a big forward out of sample tester. I run a back test with the settings that I believe would make most sense. I run an optimization to see if there are other profitable settings, and then I just put it on a demo account and I watch it and see when a loss happens, how does it happen? Does the trade go in profit and then goes back to stop loss? Or is just the direction completely wrong? Do these losses tend to happen at the same time? Or are the losing trades the ones that are open for the longest time? Because many times when you write, price will go in your favor and you will be at the target pretty fast. And if the direction is wrong, it might be very different. So you can also look at time-based stop loss and stuff. So putting it on a demo and watching it, that's very powerful.
Right. So I have this, people coming up to me and telling me that okay, my backtesting result performed this, and my backtesting, it's awesome, all of that, and it it's basically very funny when people basically show off their backtesting result, because I always think about it that you think that because your strategy has worked well in the past, it's going to work exactly the same in the future as well. But that's not the case. It's just research. It's not prediction. You're not actually predicting the market. It just tells you, because people have come up to me and said that, oh, because the last 2 years in June I was making 5% plus, last 2 years, so this month also has to be that good. I was like, no, it doesn't. Sure, market has like a cyclical behavior, but it doesn't mean that every month is going to perform in the similar scale. So I think that people should realize that they should always have this uh, at the back of their head, that backtesting is not prediction. It's just giving you researched data, and you still need to note down every single trade. You need to journal every single trade, and you need to calculate your basically calculate your results at the end of every month.
Absolutely. And this is a very hard part in trading. When you start with trading, you have this illusion that if you master the skill, eventually you have mastered it and you have arrived. You're there now. You know how to do it, but that's not the case. Um, you're going to have good months and bad months, and you cannot really prevent that at all. You can just make sure you don't lose as much when you have a bad month, and that's the same with algo trading. Also, it's very interesting. Most strategies, they will not outperform the market in the long run. In the short term, they can massively outperform it, but in the long run, they usually don't. So now you're asking yourself, why should I even run a strategy? If I use leverage, you risk a lot of money to make average returns, like in the long run. Doesn't make so much sense, but when you look at it, when you use prop firms, you have a massive edge because you don't have to outperform the market anymore. All you have to do is you have to outperform the prop firm. You just have to be profitable. That's all. And even your expected value has to be positive, means your challenge costs combined with your pass rate and also the time you can maintain an account before you lose it, because surprise, surprise, you will lose every prop firm account eventually.
Yeah.
You can still make a lot of money by just having a profitable strategy and just getting some winning streaks. Even if you lose the account after, that's very powerful. So just accept the number, look at it from a statistical perspective. How much you spend on challenges, how long can you maintain an account, how big is your average payout, what is your expected value. That's all you need to know, even if you lose the account.
Right. I think, yeah, most people need to need to start looking at it from a business perspective, that they are in this for the long run, and if they want to make money from prop firms, I think they need to have a strong sense of pattern recognition, because as you said that the strategy won't perform in the long run. So if you plan to trade in prop firms for a long time, I think you need to have, if your strategy stops working, you need to have a pattern recognition. If you need to try something new, or if you need to make a few changes in your strategy, I think pattern recognition comes in into play there. And the business aspect is just basically, you need to look at the prop firms as a risk management tool. Like you're risking, let's say you're risking $500 buying two to three prop firm accounts, and your risk is maximum $500. So you need to just make sure that you pass one of them, at least one of them, and get one payout that is worth at least 500. So you get your break even, and then you have a funded account, so you can start building consistency over time.
Absolutely. So even though they make it really hard with the rules and stuff, it's not easy at all. Still, for most traders, especially as retail traders, that's a huge opportunity, which provides you an edge that no institution has.
Right.
They cannot do this. They don't have, like institutions cannot just get some funded accounts, they
Yeah.
and just full port them or just gamble on them. So not that I recommend this, but that's a massive advantage from the retail traders.
Yeah, I think the people who can afford, people who can afford to blow or to full port multiple prop firm accounts, they probably do. They just start full porting them. I think that's also, in my personal opinion, I don't believe in, I don't think that people should just full port them, or just do the sort of like a gambling thing. I treat my prop firm like my own capital, because I do want to build my own capital up until up to that particular level. So I think the rules are pretty clear for the prop firm, and so if you treat them like your actual account, obviously don't get too attached when you inevitably blow the funded account, but I think you should treat it with rules. So yeah.
Yeah, of course. But it's just the direction that I see the industry is going to. Some years ago they said, "Oh, live account, real money,
Yeah.
we fund you,"
Yeah.
until everyone realized, "Oh, it's all B-book. It's just you're trading
Yeah.
against a prop firm. They make money when you lose." Um, And now this has changed quite a lot. For example, when you look at Apex, they have changed their challenges. Now they're so cheap. Often they have massive discounts, and then there's no activation fee. But now it comes, your payout's going to be limited. Like you need some consistency and stuff. And after I think the third or fifth payout, you just lose the account. So you cannot keep it long term. They want this fast pace. You
Yeah,
come, have you blow some, you pass some, get some payouts, you lose the account, rinse and repeat the cycle. They don't want
yeah,
people to build these massive funded portfolios and
yeah,
just drain 1 or 2% every month from every prop firm. They hate this.
yeah. So I've also I know a few people in Dubai, and they also have like their own prop firm, and so they told me that there also is like this hybrid method. So during the evaluation phase, because they have the statistical edge, they know that more than 70% of the people are going to blow their funded account, not even pass the first phase if it's a two-phase account, right? So what they do is they basically operate like a B book till the person is funded. So if you reach the funded stage, then till the first payout, they give you the first payout from their own pockets. After that, they try to sort of copy your trades, because I have had people who I have had like trader friends basically, who have had multiple payouts. I myself have had multiple payouts from funding pips, just one trainer account, right? One funded account. So I think they use this hybrid method basically after you have proven that you are consistent and you can make good returns. They basically copy your trades on their personal account, and that's why I think they can afford to give you 80% of your trade, because you're making the trade on $5,000, but they are making the same trade on $50,000. So they operate like this hybrid version. So they take advantage of the losing traders as well, and then once you have proved that you are a profitable trader, they take the same trades as you. This is, I think, most prop firms do the b-book broking as well, but I think only a few which have been in this industry for a while and they're reputed, they I think do this hybrid version.
Yeah, because of course it's a massive risk for them, because if they have someone that, okay, maybe the person got 3 payouts, costing the prop firm is the net loss with this trader. Now they can either risk that he gets another payout and they have to pay out of their own pocket, or they put him on the A book, risk that he loses the account, therefore they lose the,
Yeah,
the max drawdown, or they just ban him and damage their reputation. So that's
yeah,
that's the challenge that most prop firms have, like managing the risk. Brokers also do this, but there it's much easier because I think because you don't have so much leverage.
yeah,
You deposit 5,000, you have 5,000. On a prop firm with 5,000, you can buy 10 challenges. So
yeah.
more risk for the prop firm.
Yeah. All right, but I think that also eliminates like people who have their own capital with the broker. They will be a lot more disciplined, because the people who are buying prop firm accounts, they think with this mentality that okay, I'm buying 10 accounts, I can afford to lose 8 of them. So they are practically just spamming trades without any risk management and without any logic on like most of the prop firm accounts. So I think that is also why most of the prop firms are like promoting with huge discounts and with instant accounts, because they know that most of the people are going to have that same gambling mentality. Earlier it was with brokers, earlier it was with option traders, that they need this fast results and quick dopamine hit while they're trading. And so I think uh, the market have just shifted, but the mentality is there, like the gambling mentality is still there. So I think the market is doing what they always do, capitalizing on the gamblers, and sort of protecting the people who are actually consistent.
Absolutely.
All right. So the next section is manual trading versus the AI trading. So that was the third part, guys. Thank you for watching. The fourth part will be out soon, so make sure you subscribe. Bye.